Rocky day on Wall Street as investors wait for tomorrow's CPI data. And even though the major averages are off all-time highs, our next guest says you need to take a look at valuations. Joining us now is Jim Masturzo, Research Affiliates CIO of Multi-Asset Strategies. Jim, good to have you on the show. So your message to investors, one message is, Jim, don't throw the baby out with the bathwater. What is the baby here, Jim? Walk us through it.
Yeah, well, thanks for having me. So, what we've seen over the last 2 years in particular, S&P, over 20% returns. And now we're talking about tech everything, AI in particular. AI is going to take over the world. And nobody cares about valuations anymore. This is akin to the tech bubble, in the 90s. And so our point is valuations still matter. Yes, the US market has continued to get more expensive, even though valuations are stretched. But if we look even beyond the US market into the global markets, valuations matter. Don't throw that baby out just because AI and tech are going to take over the world.
So valuation-wise, there's obviously been a lot of talk about valuations, but there's also been the idea that instead of getting sort of just multiple expansion this year, that earnings growth is going to be able to underpin some of the expansion that we'll see. What do you make of that argument?
I think that argument is what always comes up when we talk about valuations being stretched and we need a reason for continued growth in the market. We've seen over the last year, the majority of earnings have come from the mega caps, the Mag 7 or the Fabulous 4 or whatever you want to call them. And so what happens with the other 493? Could we see expansion? Sure. But at some point, investors are going to stop wanting to pay 30 plus multiple points for earnings. So we just see a lot of risk in the U.S. market right now, just given valuations.
We're always taught, though, also, Jim, as investors, valuation, it's always emphasized, is a bad timing tool. Sentiment and positioning can be more useful near term. I mean, what are you seeing there?
It's absolutely true that what we normally see are valuations grind higher over many, many years, and then they fall like a rock. And we saw this in 2020 most recently, where things normalize very quickly. And that's actually the biggest risk, is that, yes, could we continue to grind higher? Sure. But when valuations hit, they turn on a dime, and you don't want to be wrong positioned when that dime happens.
What are the contenders for causing that? What are the triggers?
Sure. I mean, we've got policy uncertainty, obviously, being one thing. The effect of China, obviously, China's slowing down, China's property market, what that does to the global, just global capital markets in general. So not to mention all the other geopolitical risks and everything else that now comes to fruition and has been occurring over a number of years. But now we throw in, and this is not just the US election, there's obviously elections going on, coming up in Germany and other parts of Europe, shifts more to the right from maybe the center and where we've been historically. And so you throw all that into the pot, we're not sure what exactly is going to boil over from where, but the overall volatility in markets just feels more uncomfortable now than it did, 6 months ago, a year ago. This is not to say that all of a sudden, recession is going to happen or things are going to, explode in the near term, but we're starting to feel more discomfort, more uncertainty as we move forward.